Good morning, everybody. Namaan here, joined by my co-host Jenny Rae. We are here for a special live edition of Market Outsiders. It is Thursday, May 22nd. It's a beautiful morning here in Austin, Texas. I hope it's a beautiful morning wherever you're tuning in from as well. We've got an extended edition of Market Outsiders this morning. We're going to do a little bit of a deeper dive into what's happening in the business world, what's happening in the markets, what's happening in the economy. Jenny Rae, I'm excited to dive in. How are you today?
I'm so excited to be here. Hi, everyone. We are looking forward to having you here. The ones of you that are joining us live on the Zoom, we're super excited about that. And if anybody is joining us on other channels, we'll be popping the link to the Zoom in the chat over the course of our conversation so that if you do want to join us live in here, you can kind of pop in. We don't do this very often, but we thought this would be a really fun idea today to have an extended version of Market Outsiders. Usually we hit about 15 minutes, quick and dirty, right before the markets open, and we talk about business news of the day or the day before, and we actually pull it apart. Most of it is that we do not believe this about the headlines. So I'm looking forward to diving into that with you, Naman, today.
Yeah, I think we've got a lot of new listeners today. So I appreciate that context you shared, Jenny Rae. I just want to add on to it a little bit. I think our overall mission is just to help everyone understand which indicators truly signify economic health and which are just noise. And I think a lot of what you're saying is that the headlines are noise, right? Like there's some truth in them, but their job is to garner clicks. And I don't blame them. If I was in the news business, I'd be doing the same thing. But there's a difference between garnering clicks and sometimes being 100% accurate in terms of the implications of the news that you're sharing. And so, we're trying to separate signal from noise here.
Naman and I both came from industries outside of this kind of market podcast, which is why we're called Market Outsiders. And one of my jobs when I was a consultant at Bain and Company was to question the obvious, question the assumptions. And so our job, not just, we're not here today to say, pick the stock, you're going to make money if you think about this differently, although I do actually think that's true. The main thing is that when we're looking in a world full of noise as business advisors, we need to understand what matters and what doesn't. And when people ask us, how do I train myself in business acumen? This is it. This is the thing that we want y'all to know about. So we're going to dive into a couple of headlines today. Naman, you want to kick us off? You got a headline of the day that you want to tear apart, rip apart, talk
Oh my
about? Or you
gosh.
have
Oh
some
my
that you
gosh.
want to?
I've got so many. We could go for 3 hours. Let me just tee
Come
this
on,
up
nobody
really,
wants
really
that.
quickly.
Nobody
Nobody
wants
wants
that.
that, including me.
Yeah.
But let me just set the stage real quick for folks in terms of the four signals that I pay attention to above all else when I think about the economy and the markets, because these tie into the news I want to talk about today. So the number one thing that I think about when I think about economic health is employment. And so I pay attention to unemployment rate over anything else to signal like the health or the relative, sickness of an economy. Number two, I pay attention to the inflation rate. Number three, I pay attention to bond yields, like how much interest do you have to promise investors to get them to buy your debt as a country? And then number four, I pay attention to flows. That is how much money's flowing into or out of the stock market, where is it flowing into, and where is it coming from? And so I think these four metrics offer a really good North Star and a starting point to really help you figure out, okay, what does economic health look like? Does market health look like? And what could happen next? And so those above all else are the four metrics I pay attention to. And the reason that I mentioned that at the beginning of today, Jenny Rae, is because I think the biggest news of today is something that's actually not getting as much press as it should be. And it's the fact that yesterday, the auction for 20-year treasuries was weaker than expected. So here's what happens. The US government
Come that's
holds.
the most wonky thing you've ever said on this
I know. Well,
podcast.
so I'm going to try and
You're
I'm
going
going to try and
there
break it down.
today? What the heck? All right,
Yeah,
I love it. Let's
I'm
do
going to
it.
try and break it down, and then if we have
I'm going to talk
time,
about shoes. I'm talking about
okay,
shoes.
you
So
talk
I
about
can't.
shoes.
Yeah, just so everybody knows, we're not just going to talk about 20-year treasury rates all
Well, I'm
day.
gonna
Okay.
look. This is my test to see if I can make this interesting, or at least helpful. Maybe we'll start with helpful as the
I think
lower
you're I think
bar.
you're going to pass. I think you're going to pass
Yeah.
this. All right, let's
Well,
go.
here's what happens, right? A little bit of behind the scenes. The U.S. Treasury Department holds regular auctions where they issue U.S. government debt to investors, right? Whether they're domestic investors or other countries. And so yesterday, what happened is that the Treasury Department held an auction for 20-year bonds, meaning that you lend the U.S. government money and you kind of make your full money back plus whatever the yield is in 20 years. And that auction, like the
Does that
demand
happen
for
every day?
no, it happens on a regular basis, but not every day. Right, we're talking like every few months. There's an auction that's held, and yesterday's auction was specifically for 20-year bonds, and the demand for those bonds was lower than expected. And so, what the U.S. government had to do was it had to raise yields to make those bonds more attractive. And we started to talk about this on an episode earlier this week, but it's the fact that the concerns for America's fiscal health are marginally dampening demand for US debt. Right? Like US debt is seen as like this like bellwether like investment, if you will. Like it is like 99.9% safe. Like it is like the risk-free asset of all risk-free assets. It's the asset class by which all other asset classes are judged by. And so what's happening right now is that we're having to pay higher yield, aka we're going to have to pay higher interest rates to get investors to buy that debt. And one of the reasons that is happening is because right investors aren't convinced of our long-term fiscal health as a country. Another reason that's happening is because you have other countries around the world who are expanding deficits. Japan has said that they're going to expand deficit spending. Germany has said they're going to blow out their deficit spending caps. And so those countries are also issuing bonds, which makes this a more competitive marketplace now. And so investors have options, which means America has to raise yields to make its debt, equally attractive, if you will. And so, why does this matter to people listening, right? Why am I talking about this instead of talking about shoes or talking about what I really want to
We're
talk
going to
about
talk
is,
about shoes.
yeah, or what I really want to talk about is like how you make money, right? Which is one of my favorite topics to talk about, because this matters to all of us, right? Like interest payments on our debt are already the second biggest line item in the US budget after Social Security. Like, just think about that. We spend more on servicing our debt than we spend on Medicare, than we spend on Medicaid, than we spend on national defense. Like, it is the second biggest line item inside of our budget.
And
And
that's
if
not
we,
personal debt, right? Like that doesn't work because I remember actually, fun aside real quick. I read a book on the Grameen Bank in college, and one of my friends was wild enough to actually call the Grameen Bank headquarters in Bangladesh and figure out a way to go do a summer in Bangladesh. And he came away with it saying like the most powerful piece of the US economy is our ability to borrow money. So I want to,
100%,
but I
it's our
just want to say super
superpower.
clearly, we're not saying that this debt is actually even the amount of consumer debt
No.
or home ownership debt or business debt. This is a totally different number. I just want to make sure people are clear
Yeah,
on
yeah.
what the number is that
This
we're
is
talking about
government
here.
debt. This is government debt, right?
We
And
what do we
and
borrow money for, Naman?
what do we borrow money for? Well, right now
What
we're are you talking about like for how much
I'm,
yield or
I'm
like
like,
for
why?
what
Yeah, like
purpose?
why does the U.S. raising money? Why does it issue debt, and
Well,
then we have
because
to pay it
we
back?
well because we spend more than we take in.
Right? Like everybody, you guys got to know this stuff because you can't just talk about the wonky piece. You got to get down to the basics. Sorry, go ahead. I'll let you keep going.
No. And so really why I'm talking about this is because it doesn't just affect taxpayers, which it does. It also affects markets. And we're market outsiders. And so we're trying to figure out, okay, how does what's happening in the real world affect markets? This is how. If I can get, 5% almost risk-free return for buying safe US debt, which it is still the safest asset class in the world, then the risk premium I demand for other asset classes has to go up. So that means I have to make like more on the equities that I'm purchasing. I have to make more on the real estate that I'm purchasing. And as yields on this US government debt on these bonds go up, I think you're going to start to see flows leave the stock market and perhaps go into treasuries. And so I talked about earlier, like one of the signals I think about when I think about stock market health is like flows. Is money going in or is money going out? If it's going in, where's it going? If it's going in, where's it coming from? And so I think that there's a potential, and I think you're starting to see a sell off here. And yesterday, I think it's going to continue this morning when the market's open in 2 minutes, where investors are starting to think about, wait, I could get 5% risk free. What am I doing here? Right? Like now, because if I'm going to be here, I need a 12% return to factor in the risk, which no mathematical equation really does a good job of factoring in. Right? So when you think about when you think about just looking at the markets through a mathematical lens, one of the blind spots that you have is that no equation factors in risk, at least to the degree that it should or that it needs to. And so investors are taking a look this morning at the markets and saying, I need a premium for taking on risk if I'm going to keep my money anywhere outside of kind of US government bonds. And so I think that's why you're seeing the sell-off that you've been seeing happening over the last 2 days. And I just wanted to unpack that for 5 minutes because I think that that's really the biggest economic news and the biggest markets news of the day, but it gets missed because it is kind of boring.
I want to just talk about two things that might also be the wrong conclusions from this. So number one, Naman said something that's really important, and if you don't understand it, it's an important piece of business acumen. He said that treasuries are the largest risk-free asset class. And one of the things that I think a lot of people don't recognize is that cash has risk, right? Treasuries are actually less risk than cash. Because cash has more inflationary risk or depreciation risk over time, right? The purchasing power of a dollar if you hold it in cash, and treasuries are actually a hedge against that risk. So treasuries are actually lower risk than cash. It's kind of important for people to understand that like difference there, because I
And
think that's an essential piece of it. And then I'll tie it to something else. Go ahead, Naman, you want to add
no,
into
I was
that?
just going to say, can I just share some real numbers, right? So like
Sure. Yeah.
if the inflation rate is 2% and you're holding money in cash, then you have 2% less purchasing power next year. But if treasury yields are 5% and the inflation rate is 2%, then you have like in real terms made 3% on that money. So it's the 5% yield minus the 2% inflation rate. So that's what Jenny Rae's talking about, where treasuries give you protection from future inflation in a way that cash doesn't.
That's right. For a like zero different risk profile, right? I think that's really important to understand, because you're not actually taking on more risk. Here's what Naman is saying. The pressure is on y'all. If you want to go get a job, if you want to run a company, if you want to take investor money, if you want to borrow money, the pressure is on you to outperform whatever that is, that expectation is in the market. And so when we talk about tariffs and whether you should eat tariffs or whether you should not eat tariffs, right? Whether you should pass them on to consumers or not pass them on to consumers. That is not a simple decision. It's not like, oh, we're getting charged more here, we're going to pass it on there. It's, I have a demand for the capital that flows into my company and for the debt that I take on to outperform it. And I have to find that somewhere. And that comes through pricing power, and it comes through efficiency, and it comes through market outreach, right? It comes from doing the blocking and tackling of businesses. And a lot of people don't get that fundamentally. And so they don't understand why businesses can't just eat the tariffs or keep people on that may be bloated staff. It's because now my competition is T-bills. My competition is that 5% return. And so if I'm running a company and I'm going to take your money in the public markets, which are generally fairly mature businesses, I need somewhere around 7 to 8% return to factor in the risk that I'm willing to take. If I'm in the private markets, I need 10 to 15% return, right? And so I need more return based on where the risk is. And that puts pressure on you. That puts pressure on you to make more money and to spend less money inside businesses, which is why, just to tie this back to consulting really quickly, because I think we're going to take a pause and take some audience questions. In the consulting space, there is massive opportunity because there is disruption like this happening, because businesses have pressure on them and they have to deliver or die. Those are the two options that they have on the table. And so businesses, like consulting businesses, are called in to help them ensure that they deliver. In markets that have less pressure, where everybody could make money, then consulting services are actually not as demanded.
I think that's a really important point you just made, Jenny Ray. And again, like I'll tie this back to Walmart, right? Walmart's been in the news over the last week, right? Like Walmart's competition isn't just Target and Amazon, it's also the return that you can get from T-bills. And so when they're thinking about raising prices, they're not just thinking about raising prices relative to Target, Amazon, not just thinking about raising prices because of what it means for their customer base. They're also thinking about what are the returns that we can return to shareholders. Right? We have a fiduciary responsibility to our shareholders, and so we have to think about our competition in a more holistic way. It's not just competition in the marketplace, it's also where else can shareholders go to get return. That's also competition that I need to be thinking about.
And what's interesting about the 20-year T-bill is that a lot of the times the issue on that pressure comes from short-term yields, and it comes from short-term focus. And that's one of the reasons why when I watched these large private equity firms do take privates of public companies, one of the main things that they did was extend the timeline for reporting. They said, don't give us quarterly reports. We don't want them anymore. We want annual reports, or we want actually like sometimes biannual reports, right? We want these non pressured situations because we think that you cannot operate fundamentally in a market that thinks only short term and make great long-term business building decisions. And that was that was one of the main ways where in the 80s they just pumped up the debt to improve the kind of levered returns inside the business. In the 2000s, and when I was working in private equity for Bain, we were focused on long-term fundamentals, right? Can we just fundamentally make more profit if we think differently about this business? And those take privates were super powerful to be able to give people the tools to do just that, because they no longer, they already took the capital. They weren't any longer competing on the market rates, and they weren't constantly fluctuating what this benchmark was that they were competing against. It's not that Walmart wouldn't make the same decision in a private market. It's just that they don't have to make the same decision on the same timeline in the private market. And those timelines can really be the enemy of great decision making inside businesses.
Also, let's be real, in private equity, you control the marks, which means you can make the returns look like whatever you want. So
Look, the here's one thing: the house always wins, right? And in private equity, the PE firm is the house. So whether you hold the company, whether you do the operating plan for the company through your internal consulting arm, whether you made fees on the buy, you make fees on the sell, like the PE company doesn't lose. Okay.
Mhm.
But fundamentally, over time, that asset class has only improved because investors want the returns that PE offers. And PE does offer improved returns over the market and
Over
has
the long
proven to
term.
do that over the long term. And so, like you said, capital flows. There would be no business for having money in private equity sectors if because you're trading liquidity and you're trading for higher risk. You are. But the return that you have to get there still has to materialize. It's just that it doesn't have to materialize in the short term.
And we're seeing flows like move from public markets to private markets like as we speak, right? Like
Correct.
private equity, private markets are opening up to retail investors like in a way that has never been possible before. I've got thoughts that I won't share right now about that. I think that it's dangerous for folks who aren't going to do their research to just like think, "Oh, I'm going to invest in the private markets and I'm guaranteed a better return because they're private markets." But I think one of the benefits to the private markets that you've brought up is they have a different decision-making timeline. They also have a different reporting timeline. So if you look at the ups and downs of the public markets every day and like they affect your emotions, one of the benefits of being in the private markets is you don't have that daily reporting. You don't have that daily scorecard. So it can be like emotionally sometimes easier to be in the private markets because you don't see like red or green on a daily basis, and that can sometimes help you stay invested.
I see Javeth popped on, which probably means we've got a couple questions. I'm super excited to take them. So Javeth, am I right? Or should we just keep rattling on about treasury bills, Naman? What the heck?
I'm ready to talk about shoes.
I think everybody is, Naman.
While we're chatting about these bonds, my mind went to how do I get involved in this? And so I just used good old Google, and I found a Treasury Direct website where they list their upcoming auctions. Um, Pretty interesting stuff. I'll like pop a link into the chat here for people to take a look at it.
That's
Um,
awesome. And y'all don't have to buy them at auction too. Like Naman, I don't know if you hold T-bills. I do. And I use a broker, and I think Naman doesn't, and there are different reasons why we do and don't. But Naman, do you hold T-bills? Because they're really easy to buy, and there's
The,
like
they're super easy to buy. And I just
relative.
want to say we're not recommending that anyone buy anything today.
No,
So I just want to
no,
make
no,
that
no.
really, really clear. But they are
Oh,
incredibly easy to buy. You can buy them directly from the Department of the Treasury. I right now don't hold T-bills.
okay.
And we can get into that if you want, but it's just because of my time horizon. I'm willing to take the risk that comes with being in the public markets. And I am like right now, like close to 100% in equities, and I might shift my strategy here over the second half of this year. But honestly, it's worked really well for me over the last decade.
So and just so everybody knows, like we are drawing on our personal context here, but this isn't an investing podcast. But part of the reason that I actually I'm interested in this is that I hold T-bills because I'm invested in private markets. And so I park my money there when I'm waiting for private investments to materialize.
Sure.
And so I when I buy a power plant, when I buy a business, when I buy real estate, when I buy a farm, those kind of my purchasing piece of that will be held in T-bills in the short term. Sometimes when I know what the number is that I need, sometimes even before, because I'm not looking for my return to come from the T-bills or to come from equities. I'm actually making a especially higher levered return in private markets. So brokers are easy for buying T-bills, but David, just in case you were wondering, if y'all want to get them, you can basically ask just about anybody, and they're incredibly liquid. It takes about a day to settle them in and out of the markets, and there are usually no transaction fees on them too, which is part of the risk profile of that, right? Because equities have a different cost to them, both to hold them and also to transact them.
Yep.
Yeah, we had a comment in the chat saying broker is easier.
Yeah. We're going to start getting a ton of brokers on the call, like hustling our people. We got to be careful of this. Does anybody, Jason, are there any questions on the different channels? Because we're live all over the place right now.
Yep. So let's go with one here about the job market outlook. So just one question's around what is the job market outlook for the rest of 2025? And this is specifically someone interested in looking to work for a PE company.
Well, who knows? What was the quote, Namaan, that somebody said? No, I mean, this is kind of funny. This is one of my favorite consulting quotes of the year. It was like our hiring profile, our hiring expectation is full steam ahead with caution.
With caution.
like what does that even mean? That's literally the most conflated sentence in the world. So that's exactly how the firms are thinking about it, which is basically like, we will hire or run off a cliff, right? Like they kind of feel like the decision is pretty binary at this point. And so for example, in consulting, a lot of consulting firms have two hiring deadlines, right? One in July and one in September. And you can drop your resume and then you'll be kind of input through that pool, similar to college admissions. And somebody asked me yesterday on LinkedIn, they said, hey, I think I'm going to wait till the later one. I was like, you're dumb. Don't do that. Right. And it's not just because I think that they're likely to fill most of their cohort earlier. And I think there's a signal to people who identify that they're prepared earlier, but it's actually most importantly that I don't even know if they're going to get to the later one, and they reserve the right to not. And so they may not go through the process of hiring anybody by the time we get to September. And a lot of that is super dependent on a lot of things. But right now we're at basically full employment in the US. We are seeing US hiring up higher than it has been in the last 5 years, except for the post-COVID, like kind of 6-month boom right after COVID, when firms figured out that they weren't going to go out of business. It was kind of like the summer through the winter of that year. But yeah, I mean, I would say that I have a lot of optimism about it, but if you're trying to strategically time when you enter the market, right now is how you do that, because later I can't see being any better, and I could definitely see being worse. What about you, Namaan?
Yeah, well, I'll just preface this by saying, like, I have no effing clue, but there are some there are some hints that I see, right? So the first thing that I'll say is, right, there's anecdotal data that I see on our own job board that private equity firms are picking up hiring. So if you go to jobs.managementconsulted.com, you will see like openings at like the 15 major private equity shops in the US. So jobs.managementconsulted.com is where those are, and over the last 2 months, I have steadily seen those job openings increase. I'll also just say this. Like, I know that private equity firms are sitting on trillions of dollars of dry powder, right? Like they've been doing what Jenny Rae was saying. They've been hoarding cash, right? They've been kind of
in T-bills.
in T-bills, right? Yeah, they've been preparing for opportunities to strike. And like the deal making environment has been incredibly difficult over the last 2 to 3 years for a myriad of reasons. But I think right now you're seeing kind of two factors at play. Number one, you're seeing like a easier regulatory environment to get deals done. So I think you're going to start to see some of that capital come off the sidelines because of that. Number two, you're seeing like honestly like a little bit of a reordering of the global economy. You are seeing, companies that never would have been acquisition targets 6 months ago now become acquisition targets because the entire environment has changed. And like the example that I would give you is Foot Locker, right? The news broke last week that Dick's Sporting Goods is looking to acquire Foot Locker. All Foot Locker does is sell shoes. I don't know, Jenny
I
Rae, if
knew we
this
were
is what
going to
you're.
talk about shoes. No, I
Yeah.
wasn't going to talk about
Okay.
this, but I'm talking about more shoes. So
Well,
keep
this
talking
is a
about
great
shoes.
segue, right? So all Foot Locker does is sell shoes that are imported from China and Vietnam, right? So 6 months ago, that wasn't a problem. In today's environment, right, that's a problem. They became a takeover target. And so I think in like economic uncertainty, you see companies that never would have been ripe for acquisition, right, all of a sudden become available. And so because of the dry powder that private equity has, because of the lighter regulatory environment, because of like the shifting tides, if you will, in the global economy, I think you're going to start to see deal making increase. I don't think we're going back to like the boom times of like 2021. But I do think you're going to see an increase in M&A activity, and I think that's going to be good news for private equity hiring.
I mean,
Awesome. You
Namaan
want
just
to take
did the
one more
same thing that I
question
did.
before we move on?
It
Yeah,
just
go
sounded
ahead.
better.
Shut up, Namaan.
So, a question from LinkedIn. How much is ESG a current pressure point in current market scenario? We're given yesterday that Target faced losses over DEI.
You should take this one, Jenny Rae, because you broke down the numbers for Target yesterday. I'm going to put you on the spot.
Yeah, I'm happy to. Look, here's the thing about ESG is that ESG has tried to remake returns, right? So it's tried to say, like, you shouldn't just invest in the monetary portion of your return. You should calculate return with some other metric on top of it. And the markets in general have largely disagreed, right? They've said, like, fundamentally, I want to put my money where I think I can make the most money. And if ESG happens to be that place because of some other outsized advantage that you have, an understanding about, for example, a regulatory environment or an understanding about future demand that the rest of us don't have, ESG is what we'll do. But ESG for ESG's sake is not in favor right now. And largely, the more pressure that you have on capital flows in the market, the more unlikely it is that people are willing to consider an outside metric on that. So that's I think fundamentally it. It's not like whether ESG is politically popular only, although some ESG capital flows definitely are tied to public investment and public sentiment. But more importantly, ESG is just not as strong of an asset class as other asset classes are from a pure return perspective. And that's what the markets are going to look at right now. What about you, Namaan? You want to add on to that? You want to say it better, Namaan?
No. I'll just quickly say, if you're interested in Target's earnings, we broke them down on yesterday's episode. So I would just encourage you to go back and listen to yesterday's episode, because we kind of broke down some of the numbers and we talked about how some of the challenges that Target is facing, they're actually not market specific, they're target specific. And I think that's one of the things that sometimes gets conflated in the headlines as well. If it's happening at Target, it must be happening across the economy, or it must just be happening, because the US consumer is weakening. And like maybe that's true, but maybe it's not. And we argued yesterday that some of the weakness in Target's earnings is a Target problem, not a market problem. So I'd encourage you to go check that out and let us know what you think.
Should we go on to shoes? Japheth, are you
Let's
going to
talk.
let us move?
Let's do it.
All right, awesome. So I'm going to pull up a headline. Can we do this? I think this is valuable. Speaking of headlines that don't make the headlines, let's see here. Can y'all see this?
Oh, interesting. I have not seen this. This is news to me.
Yeah. So the other news that I want to share, which I think is super important today, is that Nike reported its earnings yesterday, and most of the headlines say, and I'll show you a different one that says this, that Nike is going to raise prices amidst uncertainty for tariffs. Okay. But one of the things that I really want to highlight is that Nike never said that. They actually literally never mentioned tariffs ever in their entire conversation. The reporters asked about tariffs and they said, no, we do regular price evaluations. This is the class of shoes that we're going to raise prices on. These are the classes or categories of shoes that we will not raise prices on. I think this is a really good example of how you could take the macroeconomic environment and you could say Nike is raising prices because they are responding to tariffs. And honestly, they wouldn't be wrong to do that. And if they went out directly and said it, people probably would be like, yes, of course you should, right? Because they're buying, the majority of their supply chain comes from China and Vietnam. They're incredibly exposed and incredibly concentrated on the supply chain side. But this one I thought was the more important news, right? Because this has something different about Nike's business. Nike resumed selling directly on Amazon for the first time since 2019. So let's just look at a couple of the underlying points, right? Nike confirmed on Wednesday that its shoes are returning to Amazon. Namaan, I'm going to give you a second to do. I'm going to put you back on the spot as I'm going to say, why would Nike have taken their shoes off of Amazon? Right? Help us understand what that decision might have been about. The company, and we actually talked about Nike, but not on this podcast. We talked about it on Strategy Simplified, right? We broke it down and we said, hey, like, how would you remake Nike if you were thinking about it in the future? The company stopped selling its goods wholesale on Amazon 6 years ago as part of a push to distribute more directly. Oh, dang it, I just took your line, right? To distribute more directly to consumers and maintain greater control over the experience. But I think that this is really big news. So yeah, do you just want to unpack like how we might have made that decision before, what we might have believed, and why we probably don't believe that before, or believe that anymore, and why that makes a difference? I would
Yeah.
argue it is not because Amazon is more pervasive since it was in 2019, although that could have been part of the reason. Go ahead though. How would you
Yeah.
think about it?
Okay, so the short answer is go listen to our episode on Nike because we spent like 45 minutes breaking down the business.
That's right. All the
So here,
things, all
yeah,
the
all the things.
categories, all the channels. Yeah, we went through it.
Now here's like the medium length answer for today. So when you sell direct to consumer, you protect your margins. So what Nike has to do to distribute through retailers like Amazon or through Foot Locker is they have to give away a piece of the action. And so what the calculation that Nike made was, hey, look, we are an ubiquitous brand. Everyone knows Nike. Why don't we just like vertically integrate? Why do you have to go to Foot Locker to buy Nikes? Why do you have to go to Amazon to buy Nikes? Why don't you just come to Nike.com? Or why don't you just come to a Nike outlet? And so the strategic decision that they made, which cost the old CEO his job, was that they would break
P.S. He
the.
was an ex-consultant, right?
Yeah.
Yep.
Did he come from
Dang it.
Bain?
Sometimes. Yeah, maybe, probably, almost definitely.
Um,
Yeah, he
and
did.
so smart guy. I think there's a lot that he did right, but this was like the big bet he made that didn't pay off, which was that they had decades long retailer relationships. I would have argued actually that it was these relationships that were Nike's moat, their competitive advantage. It wasn't necessarily the strength of their brand. And so I think they overemphasized the importance of their brand and under emphasized and understood, if you will, the importance of the relationships that they'd had with their retailers. And so they told Foot Locker, they told Amazon, hey, you cannot carry Nike anymore. If people want Nike, they're going to have to come directly to us. And what happened? Nike started losing share. Now you've got, like brands like Hoka, you've got other brands that I can't remember right now, right? That are popping up that are the hot brands, the Instagram brands, right? Like when I've got friends, when I've got family that like talk to me about running shoes, like they don't bring up Nike anymore. Like they bring up like On Running. They bring up other shoes. Like that's what I see people wearing now. Those seem to be the buzzier brands online. And so Nike thought, hey, you know what? Like people think we're the best. People are always going to stick with us. And I think what this showed is that people buy like for two reasons. Number one, they buy based on convenience. And when you like take your product away from some of these like channels, like it becomes less convenient for people to purchase your product. There's more friction involved in purchasing Nike. So that was issue number one. Issue number two is that, you know, there's just more ways for consumers to do diligence now, right? So like before, like 20 years ago when I would buy shoes, it's like I would just go buy Nike because I knew it was a good brand and I knew I was going to get a consistent experience, if you will. But now because I can vet all these upstart brands through social media and through the internet, like there's less risk involved with going with an upstart brand and they've started to take share from Nike. So that's the probably a longer answer than you were looking for, but that's a little bit about what's happened in the last 6 years.
I think there's a couple of other shifts that could have happened that they didn't predict, but like some businesses really focus on taking margin when they are actually hurting their top line as a result,
Yeah.
which is really, really ridiculous because you have to have a percentage of something in order to have a business. And I think that's really fundamentally the miscalculus that Nike made, which was like this: we can sell the same or more number of shoes without Amazon as we could with them. The calculus for this is we'll give Amazon some of our margin because we need top line and we can manage the margin on the back end. And I think that's a huge decision that a lot of businesses make wrong. I'll just tie it to two other businesses that I've worked with. One of them is the winery that I'm a part of. Right now, we're trying to decide whether or not we should have a distributor. All right. What are the downsides? The distributor is going to take margin from us. What are the upsides? We're going to be in a freaking lot more places than we would have otherwise. And it still may be the wrong decision, but it explains why a lot of beverage producers use these same types of things. And I would kind of make Nike's decision to go direct to consumer only similar to as if Coca-Cola were to be like, look, don't buy Coke at the store anymore where you're already going, because Amazon is a place that I'm already going. Buy it from Coke. Like Coca-Cola has an incredible brand. And if I want Coca-Cola, I might want to go get it. But the extra friction of having to go onto my website, I'm guessing Nike probably had not free shipping for every pair of shoes. They probably had certain thresholds that you had to meet, which adds additional customer friction. You have to have a new Nike account instead of your old Amazon account. You don't have 2-day performance in order to get there. Just some of the like baked in operational advantages of Amazon were gone when they went direct to consumer themselves. And that was a common recommendation for retailers in the the last decade, was like, in order to protect yourself against Amazon, go outside of Amazon and build this. But it would have been as ridiculous, I think, as Coca-Cola being like, we could ship directly to you. Right? Because it doesn't matter how much I like Coke. Some of us are going to buy on Coke, but most of us still would prefer to buy it at the grocery store. And you take it away from the grocery store and I buy less Coke. And I think that fundamentally that's what happened here. And so that's what they're saying is like, we want to sell more shoes. And we think we can manage. We think we do have brand durability. Actually, you don't sell on Amazon if you don't have brand durability, because you are risking major margin contraction. But if you do have brand durability, and if you have pricing power where you're not like, hey, Amazon, price Nike shoes at whatever you want to. Here, if you kind of negotiate with Amazon, hey, this is what you're going to sell my shoes for, then you actually just opened up a new channel, and that margin is definitely there for you to go get it. So I think there's a big opportunity with Nike doing this. Nike is also raising prices. So can I just pull that one up too, Namaan? You want to add to this before I?
Hey, if you can find the tab, be my guest. I don't know how you navigate that browser.
Oh, Namaan, I've got it so hardcore right here. This is why I keep my inbox at least 100,000 unopened.
There you go. There you go. Well, I'll just say this: you have to know who you are.
It just reminds me, you can't retire yet, right?
Not yet. I think Nike, the fundamental miscalculation they made is they forgot who they were as a business, right? So I think they saw these upstart direct-to-consumer brands, and like what some model on some 22-year-old analyst laptop probably told them is like, this is like where the shoe market is going. Like everyone buys direct-to-consumer now. Not true. Like those upstart brands had no other choice but to go direct-to-consumer. And I think, they misunderstood what the strength of their business model was. It was those retailer relationships. And instead of forcing the competition to adapt to them, they tried to adapt to what these upstarts were doing, and it hurt them.
The last thing I just want to say here, because this is kind of more, OG, typical market market outsider stuff. We're definitely not insiders. If you haven't figured that out in the last 45 minutes, then I don't know what else to tell you. Right, this is like another article that would have been the more typical article. And why I went looking for the other article was a line inside here, which is why I think it's really important to read beyond the headline. So Nike to raise prices as firms face tariffs uncertainty. Okay. Nike is not raising prices because of tariff uncertainty, although it is absolutely true. And we've talked about this for the last month and a half, that firms will raise prices. I ran the spreadsheets. When you have uncertainty, you raise prices to the worst case scenario. That's what you do. And you do it especially when you don't have to, because you're trying to test what the demand curve is. You don't know what that is. But it says this, right? Nike is set to raise prices on some trainers and clothing. That's immediately when I was like, I'm going to go figure out which ones. Because if they said which ones, that's going to tell me more about Nike's business than anything about tariffs. It also says, right, the sportswear giant did not name US tariffs explicitly. And in fact, when asked, they said, no, we regularly make price adjustments. I think this is valuable and important. What is Nike buying right now? They're buying shoes for back to school. right? The shoes that they're buying right now are getting produced and shipped in order to be on the shelves for back to school in a couple of months. And so they're thinking about that timeline. So let's go look at what it is, right? From Sunday, the 1st of June, most Nike shoes that cost more than $100 will see prices rise by as much as $10. That is higher than the tariff impact, just so that you know, right? Because the tariff impact is on a shoe that's like this is likely somewhere around 20 to 30%, kind of in the mix. That's not 20 to 30% of price, that's 20 to 30% of cost. So it may be very close to what they're charging for tariffs, but it's likely a little bit more. Right, prices of clothing and equipment will also be raised by $2 to $10, but they're raising prices on the places that they feel like people are less price sensitive, and they're also saying that we actually will not raise prices in other sectors of our business. This is really important. Nike's popular Air Force One trainers, shoes that cost less than $100, children's products, and Jordan branded apparel will be excluded from price hikes. So they're tying something together, tariffs and price hikes. The tariffs impact 100% of these things, but the price hikes are on the least price sensitive segments of Nike's business. And Nike may be doing that regardless of whether they have tariff risk or not. And I think it's really important to make sure that you separate the headline into the pieces that are actually part of the decision for a company like Nike.
What I read into this, Jenny Rae, is that Nike thinks that the higher end consumer is in a good place, which is exactly the opposite of what Target said on its earnings call earlier this week. Which is why,
Exactly. It's
if you
exactly
just
what Target said is exactly the opposite of what Home Depot said the day
exactly.
before. Yeah.
Exactly, which is one of the reasons we thought that what is happening at Target is a Target specific thing. But to come back to this, right, I think what Nike is saying is, look, like our more affluent customers are the ones who buy sneakers that are over $100 a pair. Like they have their jobs, they're continuing to spend. 50% of consumer spending in the US is driven by the top 10% income earning households. So those guys are fine. Like a 10% price hike on the shoes that they want to buy for their kid because it's the in shoe for back to school, like they're going to eat that, they're going to pay for it regardless. And so I think what's happening here is exactly what you said. Like they're testing the price elasticity of demand, and the bet that they're making is that like in that upper kind of quintile, if you will, of their consumer base, like those folks are going to continue to buy Nikes, whether it's $100 or $110 for a pair of shoes. And I think they're right, just based on what we're seeing in terms of like wages in the U.S., especially for higher income households, and what we're seeing in terms of employment as well.
Well, I know we're about to close out the conversation because even though we could talk all day about news article after news article, I don't know if y'all want to listen to that anymore. So I just want to go back to you, Japheth, and ask if there are any other questions that we haven't had a chance to address in this conversation. And while we're doing that, I just want to make sure that everybody knows y'all can follow us on YouTube. You can follow us both on Management Consulted, which gives broader sector updates, and you can follow us on the specific podcast, Market Outsiders. You can also make sure that you're following us on Apple Podcasts, Spotify, and more. And we'd love to have you join us on a regular basis. Every weekday, we are live at 6:15 Pacific, 9:15 Eastern, in order to kind of bring you a business piece of news for the day to build your business acumen and help you understand some of the key pieces. Other than that, Japheth, anything that we want to kind of integrate from our live audience today? Thank you all for joining us, by the way. We're really glad that you've been here.
Yeah, I'll just open up the chat here for any questions. So for those of you on Zoom, LinkedIn, or YouTube, questions are open. We'll leave it open for about 60 seconds. Take one or two questions here to end out today. Let me go over to those channels and see what we've got.
Namaan, we need to actually identify our birthday. We're about a month old. I don't know if today is our actual birthday, but we need to start celebrating our pod birthdays, because like we launched our first podcast, Strategy Simplified, in 2020, much to my kicking and screaming. It would have been akin to somebody coming into Nike and being like, you should stay on Amazon at the time, right? And they would have been right and I would have been wrong. And when we launched the first pod, we had, I think, like 500 to 600 live guests on the first episode. There was a huge demand for it, and we've seen a major improvement in all of our business metrics, but not for the reasons we thought. We didn't understand that the pod wasn't search, it was trust. And that was like really, really fun and valuable. But anyhow, I don't think we've even ever celebrated that that pod's birthday either, but it's coming up, I think, like in a week or two, because I think it was early June that we did our first episode in 2020. So we're probably turning 5 this year. So anyhow, do you have a date on the birthday of Market Outsiders?
Market Outsiders would be May 29th would be a month.
Come on, baby.
Okay, a
Next
week
week.
from today. I was gonna say Jenny Rae. I don't even remember how old I am, so like keeping track of the pod's age, like that's not gonna happen.
How old is
So
your soul versus like, yeah, how old is your
that's
soul versus how old are you? There's two different questions,
I
Naman.
guess so. I guess so. I will say though, I'm excited about Nike coming back to Amazon because I haven't bought a pair of Nike shoes in 5 years. Right? Like I was one of the
I
people that
just bought
didn't.
my first pair at Kohl's on the discount rack. But yeah, like I mean, I know exactly what size Nikes I take. I know what style I like. Like I would have been the perfect consumer to buy it on Amazon for the last 5 years, and I didn't do that.
Japheth, while you're still looking at the questions that are coming in, I just want to give people some homework that they didn't ask for. But there's an interesting there's an interesting article in the Wall Street Journal this week on the stealthy wealthy. And I we should break it down, Jenny Rae, in a future episode, but it's exactly what we talk about on Market Outsiders. That really like the best way to like become like an outlier in terms of your financial performance is to own a business. And this whole article was around people who own like really unsexy businesses. Like one of the businesses that was profiled in that article is a guy who literally goes into elementary schools every summer, rips up the carpet and puts new carpet down. Because like elementary school carpets are gross and for every school year you need like new carpet. And
Oh my
he
gosh,
does this.
yesterday I was in my kid's kindergarten classroom and I was like, well, is it going to be carpet cleaning or replacement? Like it
Yeah.
1000%. That's a phenomenal business.
It's
Never
a
thought of
phenomenal
that.
business. Like he's built an 8-figure business just doing that, like in his region. Right. The guy who founded WeatherTech was profiled in that article. They do like what do you call them? Like floor mats for cars and other car accessories. Right.
Oh man, I love my
Right.
floor mats in my
Yeah,
car.
he's worth over 100 million bucks, and I just thought like this article is really a microcosm of what we're talking about at Market Outsiders. Is that if you understand like basic economic principles and you can apply them right to business ownership, like you have like a better chance than normal to become a financial outlier. So I just thought it was really interesting, and I'd encourage people to go figure out like to go read that and figure out like how they can become a market outsider in their own businesses and in their own careers.
It was a takeaway that I didn't know I was going to get from consulting, which because consulting firms intrinsically understand that human capital is your best capital. Like they don't think of financial capital as their most valuable capital, and so I have applied that in every other business that I've owned, understanding that the money that we have and the money that we make is not our most important capital. It's the people that we put into the business, and I think if you get that, then you understand that like that's where your primary investment and your moat comes from. And that actually is regardless of business. The human capital inside a business is the most valued piece of what you have. All right, Japheth, any
Yep,
final questions before we should?
we do.
Okay,
We
great.
got a great one from LinkedIn. I really like this one. So
What's up? What's up,
what might
LinkedIn?
be some common frameworks that consulting firms use when helping their clients decide whether to absorb tariff costs, pass them on to consumers, or relocate supply chains?
Ooh, I like that one. You want me to go first, Iman?
Go for it.
Yeah, I mean, I ran these models, so I guess I should kind of take ownership for the understanding of how we're thinking about it. Look, I think that what we talked about before is going to be super important. I think that understanding Porter's 5 forces here would be an incredibly important framework to begin with. The firms won't always say Porter's 5 forces explicitly, but one of the number one questions is just supplier power, right? How much of our ability do we have to actually negotiate back to our suppliers to diminish the costs that are coming in because of tariffs? Because tariffs don't only have to be passed one way, they can be shoved the other direction depending on the supplier power that we have. Somewhere like Walmart has actually a pretty significant amount of supplier power, and they're already saying that they're probably going to have to raise prices because of tariffs, but they're not saying that they have to do it at the level that they would otherwise. So there's not just whether you're going to pass tariffs on, it's also how much would you pass on to your consumers, and supplier power is one of the first things. Another major piece, and maybe even primary to supplier power, is just your elasticity of demand, right? The power that you have over your customer. And if you're significantly important to your customer, both in terms of what you offer and how frequently they buy, that's really important, because if you're very important to customers, but they can stretch out the timeline between when they buy from you, then that is a very different issue. It's one of the reasons that I've loved HVAC businesses for an incredibly long time, right? Because there is certainly a reinvestment that happens when people have capital to buy and upgrade a new HVAC business, but a large portion of HVAC businesses come from parts. And when are those parts spent? It's when in the middle of a heat dome in Austin, Texas, Namaan is like, oh my God, I cannot go more than 24 hours without having my air conditioning on. My air conditioning breaks. I will pay literally whatever price in order to get it fixed. And so there are businesses that have a lot of insulation. Like Namaan wasn't going to negotiate with the guy when that happened in general, but he also has urgency around it, and therefore he's willing to basically pay whatever is required in order to do it. There are other businesses that don't have that luxury. And so they're going to try to understand those two things. And then the third one that's actually really important is the channel that I sell through, right? So how much margin is my channel taking from me? So right now in my winery business, for example, bottle costs are a piece of impact from tariffs. I already have pretty high margins in my winery business because the mix of what I sell is largely through my tasting room. So I can absorb that cost or pass it on in a nominal way really simply. But if I were selling everything at wholesale, that percentage of my cost would be a lot higher versus the price that I'm getting for those products. And so I'm thinking about the channels that I'm selling through and maybe whether I have a mix shift, and I want to have a mix shift in channels like the one that we talked about with Amazon today, are a couple of the key pieces. Anyhow, if you haven't looked at Porter's 5 Forces, we have a great article on it on Management Consulted. If you don't understand what those are, that's kind of fundamentally the numbers that you'd go through. And then basically it's just sensitivity analysis, right? How much, what is the like wildest change that we could that in our kind of supply chain that we could stomach across the board? What's the mix of where we're manufacturing things? Is there a good reason to shift our mix, not just because of tariffs, but because of other long-term sustainable cost issues or supply chain issues? And then I would take a look at the entire system. But those are the three main things, right? Customers, channels, and suppliers. You want to add on to that, Namaan?
Yeah, I'll just say I think Home Depot is a really good example of what you're talking about. They're leaning on their suppliers really hard right now, right? And they're telling suppliers, if you don't shift manufacturing out of China, we're going to switch suppliers. And so I think when you have like a more consolidated supplier base, you can do that. One of the things I found interesting about Walmart is that 40% of Walmart suppliers are small businesses. So I think they have power over their suppliers, but actually not as much as I would have expected because like they have a fragmented supplier base. And so that's not the case with Home Depot. So they're leaning on their suppliers saying, look, like you are not passing these cost increases on to us. Otherwise, we're going somewhere else. And so I think the laziest businesses default to just raising prices first. And like your North Star is like, we're going to protect margins, but there are a lot of other ways to protect margins, without raising prices, at least not to the full effect of your cost increases. And so I think Home Depot is a good example of some of the other levers that you can pull to protect your margins while also remaining competitive from a consumer perspective as well.
Look, I think one thing that we could just also harken back to is what happened during inflationary pressure, right? Inflationary pressure is actually created very similar business scenario planning to what tariff pressure is creating. And so this is not the business's first rodeo in going through some of these changes. That inflationary pressure affected the whole supply chain and actually affected labor, which for many of us is something that's not impacted by tariffs, but was absolutely impacted by inflation. And so a lot of the businesses started asking those same questions. The ones that were able to take price have had sustainably higher returns, right? So taking price is a factor that they want to test out. But like Namaan said, the same way that businesses shouldn't just go to raising prices, in competitive market environments, they also shouldn't just go to lower prices. And a lot of them had unsustainably lowered prices because they thought that customers were more elastic than they were, and they didn't see that elasticity, or it was masked in the other data that they were looking at. And so they didn't recognize where there was opportunity to take price. Once they did, because inflation was the narrative, they actually recognized that the customer wasn't that price sensitive after all. And then they were able to sustainably have higher margins as they were able to manage costs down at the same time. Javis, any other questions?
I think that's it for today. It's a good time to wrap up.
Awesome. Great. Well, we've been on for just about an hour. Thank you all for joining us today. If you liked this extended live, would you just leave us a comment? Please make sure that you subscribe. Look, Namaan didn't dress in his best today, so that's a pretty big day for us. And so, we have to look real pretty when it comes to these extended lives. But if you like that and you like what we did today and you want to see more of it, we'd love to for you to let us know. But we're super grateful that you're here. We hope you got a lot out of the episode today. And we will be on same time, same bat channel, normal format. So just quick and dirty tomorrow at 9:15 Eastern, 6:15 Pacific. See you tomorrow.